Lamond, CEO and co-founder at Neovision Wealth Management. Ryan, so let's just start where Avril left off there, and that's in Asia. Chinese equities seeing a bit of a modest lead over Indian equities. I mean, how long do you think this really has to go here?
Morning, Jen. Well, regarding Chinese equities, we've been positioned since June, preparing for what we hope will be a bazooka intervention by the Chinese government or Chinese authorities, which we think eventually will come. And we've seen it in the think tank that has recommended a $281 billion package to boost markets and boost the economy. So we are positioned for it. It will be very volatile, but we do think there is value there and big upside.
What is the next catalyst then, Ryan?
The big catalyst is the bazooka intervention, because as long as this bazooka intervention, and let's remind people, bazooka intervention is something the Chinese government does whenever there's a crisis like 2008, like COVID-19 period, and it goes in and it lifts absolutely everything, stock markets, economy, etc. Now, will it lift the consumer? This is the big question. But as long as financial markets are lifted up, this will feed into a wealth effect and hopefully feed into the consumers who will boost their consumption. So the catalyst is announcing a big package like the one that was recommended by the state-linked think tank of $281 billion.
But Ryan, you are bullish there, clearly on Chinese equities. But I wonder if there's anything else that could potentially get in the way of that. As you mentioned, it's going to be bumpy. There's a lot of volatility that's expected. I mean, what could potentially derail that expectation?
Derailing it is debt. Obviously, China is very much in debt. The second is the consumer not reacting to a rise in stock markets and increasing their consumption. Another one is geopolitics. Let's not forget China-Taiwan is still in play, and this is affecting. And third, obviously, is the relationships with the US, tariffs, things getting more tense, and generally economic growth faltering. So there are multiple risks there, hence the volatility. Hence, we hope the return to compensate for that volatility.
Let's pivot to the U.S., Ryan, because this week we were mentioning we're seeing a global bond sell-off, and a lot of that has to do, we mentioned, with Fed rate cut expectations. There's also fiscal concerns. I mean, does the bond sell-off then continue in your mind?
Well, the bond vigilantes are back, and they are saying to the U.S. authorities, both the Fed and the Treasuries, you cannot keep on deficit spending this way, where 50% of jobs created are government-related or government-boosted, and expect things to be fine. So this is what's holding up the economy today. So yes, again, the bond market will be very volatile up to a certain point where it becomes interesting to come in. So this is where we are today.
Interesting to come in. When is it interesting for you to come in? Is now the point?
Well, it's getting close, to be honest, though we are looking at the shorter end. So we've never been on the longer end, 10-year or above. And I've been asked by your colleagues about it. It's about duration risk. The longer you go, the more volatile it gets, the riskier it gets. And we did expect this to happen because fiscal spending continues to happen at a very high rate. That's why we remain in the 1 to 3 year portion, which has done very well until now. We've booked profits, and now we're preparing to get in again because it's starting to get interesting. Let's not forget, Jennifer, that equities markets in the US are at the moment pretty much controlled by the retail, whereas the bond market is institutional investors, and institutional investors are concerned today.
So then, Ryan, broadly speaking, I mean, asset allocations, you talked a little bit about where your position in terms of bond yields. I mean, where else are you looking right now?
So we're looking at India as well, obviously. So India for us is China 15, 20 years ago. Yes, it is risky, but there is value there. We're looking selectively at the US and Europe. So for example, in the US, we're picking up the sectors that everyone is dumping, like renewable energy, which is for us an ancillary to the AI hype, because all of these data centers will need a lot of energy, and hopefully a renewable one. So this is where we're investing. Again, related to the Chinese pickup of consumers, like consumer staples, Nike, for example, it's literally in the floor. So we're picking it up. Gold, we're very much bullish on gold, and every dip we're buying.
You're buying the dip, Ryan. I was just going to end there. I'm glad you said it, though, for me. Ryan Lamond, CEO and co-founder at Neovision Wealth Management, starting us off this morning. Thanks so much, Ryan. Also,